You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRoque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. I am going to continue on the series of Mythbusters again today. Today's Mythbuster is a myth that's been circulating among the general public. It's just that borrowing against your policy will cause you to lose money. Now, this misconception could deter you from utilizing policy loans, depriving you of these awesome, flexible financial resources. So the idea of borrowing against a life insurance policy leading to financial loss might stem from the confusion about how policy loans affect both the policy's cash value and the death benefit. Some people believe that taking a loan equates to withdrawing money directly, instantly reducing the policy's worth and future payouts. Others might fear that the interest rates are complicated or assume that the insurance company benefits unfairly from these arrangements. Incorrect information spreads easily, especially when financial concepts are complex and not adequately explained by advisors or insurers. So let's unravel what actually happens when a policy loan is taken out. And I'm sure some of this information will seem like you've heard it before because I cover it in different podcasts and different things that I'm talking about. I just wanted to make sure I captured it in this particular Mythbuster. So whole life insurance policies accumulate cash value over time. That cash is built by premium payments, interest earned, and dividends. Policyholders can borrow against this cash value, similar to taking a loan from a bank, but with several unique advantages. One, the policy's cash value serves as collateral for the loan, making approval automatic. This is different than a loan from a bank because although they may want to ensure that you have collateral before offering the loan may still not be easy to come by. And there's a lot of steps before being approved for a bank loan. Not to mention that you have to disclose every single piece of financial information about yourself and maybe sign over your firstborn before they will give you the loan. It's a very long and painful process. I remember the last time I tried to get a bank loan, I was on the phone for easily 1 to 2 hours. I had to get my husband in the room. We had to submit tax returns. It just seemed endless, and it took at least a couple months to get approved, and you've got to make sure you have all this financial information to submit. Not so with a life insurance loan. It's much easier. There's also no credit check like there is with a bank loan. Since you are borrowing against your own policy, there is no impact on your credit score or need to qualify. Another very unique advantage to a life insurance loan is flexible repayment. I know I talk about this a lot, that one of the most awesome features of policy loans is that you do not have set repayment schedules. Interest accrues, but you can choose how and when to repay. In addition, if you do repay your loan monthly or whenever you send payments in, those payments go directly to paying down the principal. So therefore, it makes your life insurance loans the most efficient type of loan that you could possibly have. Also, there is continued growth. Your cash value continues to earn interest and dividends per the policy's terms. Even though you may have borrowed the full value of your collateral, your cash value continues to earn the full value of your cash value. So when borrowing, the insurance company lends you money using your policy as collateral. The company does charge interest, which is something people are sometimes confused about at first. I have some nifty calculators to help you understand how this all works and how it's very much in your best interest. But you would want the company to charge interest anyway, because so long as you have a policy from a mutual insurance company, you are an owner of the company and you would want your company to be profitable because those profits come back to you in the form of a dividend. The process of borrowing against your policy can be repeated as long as sufficient cash value exists. The myth that borrowing against your policy's cash value will cause you to lose money may come from three main concerns. The first one being a reduction in cash value. When you borrow against your policy, the loan amount is deducted from your available cash value. However, the total cash value, including the amount you borrowed against, continues to earn. You continue earning on the full gross cash value amount. The impact on the death benefit could be another concern. If the loan is outstanding when the policyholder dies, the insurance company repays itself from the death benefit and also minus the accrued interest. This reduction is not a loss, but of course, a logical consequence of an unpaid loan. If the loan is repaid during your lifetime, the full death benefit is preserved and paid out tax free to your beneficiaries. In addition, the death benefit starts growing the day you begin paying your premiums when structured correctly for IBC, because that's exactly what paid up additions do. They pay up additional insurance. So if you were to pass with a loan outstanding, it's very possible that even after deducting the loan balance and any interest that had accrued, the death benefit you leave to your beneficiaries could still be larger than what you started with. Another concern that causes people to believe that policy loans will cause you to lose money is the interest. Policy loans do accrue interest. If they are left unpaid, the interest will compound and the loan will grow. The loan balance will grow. If you ignore your loan and only always borrow the maximum possible each time there's funds available while never repaying the loan, this would eventually exhaust your cash value and could cause the policy to lapse in the long run. You don't want to steal from yourself or steal the peas, as Nelson Nash would say. So it's important that you honor your own money and your own loan in the same way that you would a loan from a bank or borrowing money from a credit card company. You would never dream of trying to get away with taking a loan from a bank or credit card with the intention of never paying it back. And if you did, that dream would end real fast. And actually, it's pretty amazing how you could be taking loans against your policy where the insurance company will never require any loan repayments and still have your available cash from which you're able to borrow from grow. Can you imagine taking a loan from a bank, not paying anything on it for a year plus, while having your available funds continue to grow and actually be able to access them with no questions asked? That would never happen with anything other than a life insurance loan. A bank will always require some sort of payment, even if it's just interest only for a period of time. So, as long as you're repaying your loan on a payment mode that works for you, your loan balance will be shrinking while your gross cash value account will be increasing. So, over time, you will earn way more on your account than you ever paid in interest. And that interest the company is earning is coming back to you in the form of a dividend. As I mentioned earlier, when you pay down your loan, each one of those payments goes 100% to principal. So it is paying down your loan faster than any other type of loan that you could have from any other place. And therefore, you will be paying as little interest as possible. A couple of risks that you want to protect against are letting your policy lapse. As I mentioned before, you don't want to only borrow without ever repaying. Really, in your earning years, your building years, you don't want to be doing this. This could get you into trouble in the long run. Although, once you do reach your retirement years, we can make a plan where you're pulling funds out from your account without the intention of paying them back. We will have a whole plan and process to be able to do that. But during your earning years, during your years where you're accumulating this cash for use for whatever you might use throughout your younger years, and then you want the money to be there again in retirement, you're going to want to replenish the funds and recycle them and can make sure you're paying the policy back. You don't want to just be depleting your whole entire life. Then when you get to retirement, there won't be anything there if you just keep depleting it every single chance you get. Another thing, you wouldn't want the policy to lapse when you have loans outstanding that are over and above your cost basis. In addition to losing the death benefit, if your policy lapses or you terminate the policy when you have a gain in the policy, those gains will be subject to income tax. You want to make sure to be a responsible borrower, monitor your loan balance, pay yourself back with interest, and ensure the policy remains funded. Now, some other unique advantages or benefits to this process or to borrowing against your policy are that you have liquidity, tax advantages. Loans are taken tax free unless your policy becomes a MEC, because then those gains are taxable even when taking a loan. With a policy loan, you have no repayment pressure. As I've said again and again, you can repay loans on your own schedule. You can come up with a schedule and then pause or change it anytime. You can increase, you can decrease your loan repayment or take time off from paying anything at all. You just don't want to keep squeezing all the cash out of there and borrow every chance you get without ever replenishing anything back. That's not going to be very good for you. Another benefit is the ability to preserve other assets. By borrowing against your whole life policy, you are able to avoid selling assets, incurring taxes, or disrupting other investment strategies when funds are needed. Here's a couple of real world examples, some real easy ones. Let's just say you have $20,000 available in your cash value account in your whole life policy, and you have an emergency. You need $10,000 for an unexpected medical bill. So you can choose to borrow from the policy. You can choose how long you will pay it back. Maybe you decide to pay it back over 2 years. You choose to pay yourself interest, and the whole time your policy remains intact and your beneficiaries are unaffected. Another example, you might have an opportunity for an investment. You instead decide to borrow $20,000 against your account to invest in a business. The investment grows, the loan is repaid over time, however much time you want to repay the loan, and the policy continues to build cash value and continue to earn the entire time, even though you use those $20,000 to invest in a business. In both cases, the policyholder, you as the policyholder, would not lose any money. You would be able to leverage your insurance policy to address immediate needs while maintaining your long-term protection and maintaining the earning power of all of the funds in your cash value account. Bank loans, credit lines, and credit cards often come with high interest rates, that lengthy approval process that I just went over, and strict repayment terms. Policy loans are low pressure, flexible, and private. No questions asked, you will receive your loan. Used wisely, they represent a more efficient and less intrusive way to access funds. In conclusion, borrowing against your life insurance policy does not inevitably cause you to lose money, and it's still the best type of loan that you could have. And those same funds will continue to earn for you. They're also protecting your loved ones with a death benefit in the event something happens, something tragic in your younger earning years or at any time. And even as you access the funds for a different purpose, they continue to earn for you. Now, I also wanted to mention that if you happen to have a topic that you don't fully understand or a question that you haven't heard answered in any of my podcasts, feel free to reach out to me and I just might do a podcast to answer your question. I have covered many, many topics, but if you've listened to them all or most of the episodes and you feel you have a good content idea and that you would like some more light to be shed on, feel free to let me know. I get great ideas for podcasts from talking to clients all the time. In fact, I was just talking to someone the other day who mentioned, hey, you should do a podcast on this topic. And I agreed, and I didn't write it down right away. And so now I don't remember what it was. Darn it. But I do think it's fun when someone comes with a question or something, and it happens to be something I haven't gone over or covered. Sometimes I don't realize that there's some great topics that I haven't covered yet. In addition, if you are simply feeling ready to get started and you would like to work with me as your IBC practitioner and advisor, feel free to reach out to me. You can reach me at Valerie@alphaomegawealth.com. Thanks as always for listening, and I hope you have another great week.